Trading price action trends. Technical analysis of price charts bar by bar for the serious trader. Chapter 2. Trend bars, doji bars, and climaxes. There are only two types of bars, trend bars and doji bars. The market can only ever be in a trend or range at any time. Trend bars are controlled by one side, bulls or bears. They have little to no overlap and show the market trended away from the opening price. Doji bars are range bars. They have tails on both sides with small bodies. This shows the market is more 50-50 rather than a trend. When bars have lots of overlap, this is also a form of a range. A bull bar followed by a bear bar is a range. On a higher time frame, it will be one bar with a tail. There's many names for trading ranges. However, the most important thing is to understand the market is at an equilibrium. Trading ranges fail at extremes. This is a good chart to show trend bars and doji bars. Here we can see the breakout. These bars are orderly and the tails are small. This is a pullback bar with a bull body, so that's good for the bull trend, and they have strong closes. Bar 11 is the first break of this trend line, and that starts the second leg. The second leg also has good closes. They're all strong, trending away from the opening price. After the market gets a few legs higher, we go sideways. When we go sideways, we see more dojis, and dojis signify overlap. So now we can say the context has changed. The market goes for a pullback, and we enter a range. Here, when we break out the range, we don't see as many dojis. It goes to trending again. We open at a lower price and close at a higher price. Open, close, higher and higher. And then when we go sideways, we see more dojis again. So the market's either trending or in a range bound with dojis. This is the bull leg in the previous chart we just saw. Here's that first pullback that led to a second leg with good closes. 5 minute, 1 minute. I just wanted to show you guys this overlap and how it's really easy to get chopped up. On the 1 minute, it looks like it keeps breaking out, but we reverse lower. Then this bar looks like it's breaking out to the bear side, the downside, and it reverses. This is right here. So on a lower time frame, we can get a better idea of what's going on, but we should still stick to the higher time frame and just realize it's just a pullback. Let's wait for the tag of the EMA after 20 bars. So here's an example of some range-bound price action. In the previous slide, I mentioned how the bars don't have to be doji bars to be range bars. What I meant by that was these bars are breaking out and they're all good-looking trend bars, but we're failing to make new highs. We fail at resistance, bears fail at support, and we reverse to the opposite side. So these are good trend bars, and these are tradable legs, but look on the higher time frames. They make dojis with lots of overlap. So that's just something to keep in mind, that you could be trading trend bars, and on a higher time frame, it's a range with lots of overlap. The two most important concepts in trading are that there is a mathematical basis for everything, and that at any moment when you are convinced of the market's direction, there is someone equally smart who believes in the opposite. Page 59 in Trends. Never be fully convinced you are right. The market is usually more 50-50 than we realize. For every side to your trade, there is an opposite side that has a good chance of succeeding. Being able to view both sides will keep you nimble. If you can only see one side, consider taking a break or going for a walk. So here we have two charts. There's one chart here and one chart behind the notepad. The question is this a bear trend or a bull trend? We have a gap up with a strong bar made by the bulls. It's a gap bar and it's a climax bar, but bears get the reversal and break out below the EMA. They trade lower for the rest of the day and have strong big bear bars at the bottom of the bear trend. Bulls are starting to step up, but there's a lot of selling pressure. Do you guys think this is the start to a sell-off or a bull trend? If you said bear trend, you would be wrong. This double bottom ended up being strong enough trap bears down here. They buy back their shorts. People see this strong trend, bear trend, and they try shorting for a few days and they get trapped adding to the bull side, and this creates a multi-day bull trend that went on for, let's see. So here's a low, 1, 2, 3, 4. The chart is showing at least 5 days. So things are not always as we seem, and we have to let the price action tell us what happens. If bears are not breaking below the EMA, then don't get short. Wait for multiple bars, and if you don't want to get long, then you're just gonna have to wait. But the idea is, this looks like a very strong bear trend that led to an even stronger bull trend. This gap down looks like it got continuation. R1 has followed through with a leg lower, a pullback, and another leg lower. However, this gap down ended up being climactic, and it led to a bull run for 2-3 days. There's a very big gap up that broke above this range, and bulls had a pullback into the EMA and then continued higher. This was a buy the close rally. People may be bullish looking at this chart. However, this ended up being the start to a huge sell-off. That was a double top. I actually remember buying this bar and I had to hit out quickly because it was growing. I missed most of this trend. And this is just another example of how the market looks bullish and we get a huge bear surprise. This bear surprise was big enough. The bars were growing, breaking past it. It reversed this gap, reversed this low. The bars were getting bigger. The lower the market went, the bars got bigger. So the bear trend was getting stronger, not weaker. This break, all these bars lined up is one big bar in a different time frame. This big bar in a different time frame led to a huge sell-off. It was a 3-week sell-off, 8, 15, and 22. It's this bar right here. We went sideways. This bar was all the bars we just saw, and it broke past these previous bars range, and we sold off for 3 weeks. So you can see how things aren't as they seem. Here's that big gap up. Gap ups are typically bullish, and this led to a huge sell-off that was a multi-week bear trend. When learning how to trade, it's important the trader can identify if a trend bar is the beginning or end of a move. It's best for the traders to think in terms of, is this a trend bar or a doji bar? Keeping this type of thought process will help you read the markets and learn when to sit out. It's advised new traders avoid tight trading ranges. Getting caught in a tight trading range can quickly eat up the trader's profits on the day. Whether you have special names for dojis such as hammer or harami, it doesn't matter. What matters is being able to tell if the market is trending or not. Here's that same chart we saw before that was somewhat trending. We had bull bars and bear bars. I measured out these ranges where we would buy here and maybe sell out here. This is a 10-point range, 7-point, 8-point, and 5 points. If you didn't get chopped up in this range, because in reality, 7 points is from this bar to that, but this was even tighter. It was about 5 points for an hour. So if you didn't get chopped up here, you would catch this move EOD. On this day, if you missed this leg, it's very easy to hold on to a long and get trapped right here. It's easy to get trapped right here and hit into a short and then get trapped to the short side. Tight trading ranges look easy to sit out, but in reality, they always look like the market is breaking out. That's what makes them hard. And we have to learn that when there's a big down move and a big up move, there's a good chance of a tight trading range. Big down, big up. Big down, big up. Big down, big up. 3 legs lower. Leg 1, pull back, leg 2, pull back, leg 3. Leg 1, pull back, leg 2. So big is relative in this, right? For this trading range, that's the whole range. So that is a big down and big up move. And then we went into a tight trading range again. I've been caught. These are the days that eat up my profits. So it's really important we all pay attention to these if you want to get profitable. Because I was right. These will destroy your profits on the day. Reading the markets is subjective. Trend bars can be read in different ways depending on the context they're printed. Trend bars can act as breakout bars, climax bars, and gap bars. All of these bars offer different trading opportunities. Breakout bars can be the start to a trend or a reversal. Climax bars can signify a trend is coming to a temporary end, and gap bars show that one side has strength. If gap bars are closing, the market could be range bound. All these bars look like trend bars, however, the context for all of them are different. Pullbacks happen after a trend bar. Pullbacks can either be with trend entries or the start of a reversal. They come after trend bars, eventually. These are the three types of trend bars I was talking about: breakout bars, climax, and gap bars. I'm going to leave this slide up for 10 seconds, and I want you guys to tell me in the comments, or just say it to yourself, which one of these bars is a breakout, which one is a climax, and which one is the gap bar. And then I'll switch to the next slide and show you guys. So honestly, it was a trick question because we don't really know which one is a breakout bar. We don't know which one is the gap and climax bars. All three of these have gaps from here to here, here to here, and here to here. All three of these are breaking out from here to here, here to here, here to here. And all three of these have climactic price action. So there really is no way to tell until we see the context of the chart these bars are in. So here's the chart I pulled those bars from. And the answer was breakout, gap, and climax. I put them in order because there was no real way to tell, so I just put them there. Here we see these bars are breaking out from this bull flag. It's breaking out of this range and they're big. It gets follow through. This bar is a gap bar. From here to here, that shows bull strength. Now this isn't the only gap. There's a gap bar here, there's a gap here, gap here, gap here, gap here to here. This is a gap from the high of this range bar, doji bar, to the low of this trend bar. The third picture from the previous slide was the climax. It was late in the trend, and look, the gap closed. Remember I said that when gaps start closing, that could be the start to a range? This was the first gap that closed, and the market went sideways for the rest of the day. So it's hard. So these bars look all the same, but where they are in relation to the price and what happened prior is different. So they have different meanings. Breakout, gap bars, climax. An ideal trend bar is a bar with an average sized body and no tails. If the bar becomes too big too fast, then it could be read as a vacuum test of support and resistance or a climax. If trend bar starts to stack in one direction, this is a sign of buying or selling pressure. If the market is in a bull trend and bear trend bars start to stack up, the market could be going range bound. Same for the bears. If the market is in a bear trend and the bull bars start to stack up, the market could be going range bound. So this is a pretty cool chart. It shows a bear trend turning into a bull trend. The bear trend starts out breaking out below the EMA with several legs lower. This range tells us we're at the end of the market cycle and wait for a breakout. As the bullish pressure starts to stack up with gaps from here to here, here to here, and an opening gap here, bulls get the breakout and bear bars disappear. What makes this interesting is because of the next chart. The next chart is bull to bear, but it shows the same thing. This is the prior leg. Here are all the bull bars, and then bear trend bars start to stack. We see a two-legged bear pull back here that tests this gap, and then another leg higher. The market goes sideways and bears close these bull gaps right here. After these bull gaps get closed, they pull back into the EMA and bears get the breakout. So the market works in a rotation. We saw bear to bull to bear. This is the end of chapter 2. Please leave any questions in the comments and I'll try my best to answer them. Thank you for your time, and if you learned anything, please consider subscribing.